We hear about people living paycheck to paycheck all the time, and it really is as common as it seems. As of last month, 1 in 3 Canadians blow through their entire paycheck every single time that they get one. And most of those people are spending every single penny that they make every time that they get paid, and some people are even spending more than they make. So basically they're going a little bit more into debt every few weeks. So on top of not being able to save for retirement, people aren't even able to save for small emergencies. Over a quarter of the population says that they wouldn't be able to come up with $2,000 if an emergency did come their way. And then there's other scenarios, like if you're switching jobs and you have irregular paychecks for a few weeks, that can cause some really big cash flow issues. So when people are living paycheck to paycheck, where do they go to if they really do need the money now? Unfortunately, as of 2021, 2 million Canadians are getting that money from payday loans, which is about 5% of our total population. Payday loans, you might have heard them called cash loans before, cash advance loans, payday advance loans. Basically, they're short-term loans that have high fees and interest rates. Now, the maximum that you can get right now is $1,500 per loan, and it's due to be paid back the next time that you get paid. But if we take a second to look at how that actually works, if someone's spending their entire paycheck or more every single time they get paid, and then an emergency comes up that they obviously can't afford to cover the costs of, so they decide to take out a payday loan to cover the costs instead, but then they have to pay back that payday loan at their next paycheck, but your next paycheck already has all of the money accounted for because of your regular expenses that always take up your entire paycheck. How are you ever supposed to pay that loan back? And remember that you're not just paying back the $1,500 loan, you're also paying those high fees and interest rates as well that grow more and more every single time that you miss a payment. Now that's just the surface of the problem.
Payday loans have been around for over a century, except that's not what they were called at first. In those early years, they were known as loan sharks, so we're talking high rate, small dollar value loans where cash lenders would charge up to 500% in interest per year, usually to working class borrowers. They started popping up in the early 1900s after regulations made interest rates that were legal for banks to charge on small loans unprofitable. So the banks basically turned around and said, you know what, we're not even gonna offer them anymore. This pretty much opened up a new lane for these small lenders who are offering these quick loans at profitable, and I mean highly profitable, but also illegal interest rates. Even though the contracts weren't actually legally enforceable, the people who took out these loans could be blackmailed by these small shops if they didn't pay back their debts. Basically, they would threaten legal action despite the fact that it was an illegal business to begin with, so good luck playing that out in court, or they would publicly shame people. So for a lot of people, it was really embarrassing to have your community and friends and family find out that you needed the loan and actually took it out. So clearly it's a bad spot to be in as a borrower, but what about the lenders? Well, at the time it was only a misdemeanor offense and a lot of the victims couldn't afford to sue them, so the risk wasn't really that high. Now, as a result of that, over time, these lenders became more and more powerful and started to use violence and threats of violence to actually get people to pay back their debts. And that's kind of ultimately where we get the term loan shark. So eventually the public became super concerned about everything that was happening in the industry, and some regulations were put into place, but kind of like everything else, what typically happens is that it either goes underground, the business does, or they kind of shake things up and it turns into other forms that are pretty much just a remake of the exact same thing. One of those businesses is check cashing. So this is one of those services that allows people who don't have a bank account or who need cash really quickly to just get their check and then take it to this place and then they'll cash it for you right away. Now, what really sucks about this service is that it tends to charge people really high fees for money that already belongs to you. But at the same time, there's still a really big population of people that are living in underbanked communities where they don't have access to some of the big financial institutions, or they don't know that they can use a credit union, for example. At the end of the day, there's people who just really need fast cash, and because the service exists, they're willing to also forego some of the money that they're already entitled to just to get their money as quickly as possible. The way to look at it is that it unfortunately became one of the solutions to the pitfalls of the more traditional big banks. With banks not being accessible to the entire population, with banks not being available to people with low credit scores, and with banks having high upfront fees even if they were more cost effective over time, it kind of created this big demand for these predatory businesses. Something to keep in mind is that the traditional banks are also predatory in a lot of ways, with them not being available to a solid portion of the population and also relying on customer misinformation. That's just something you should think on. Why is it that we don't use the same language when we're talking about the bigger banking system?
Now, once we hit the 1990s, that's when the payday loan industry started to look like how it still does today. It took it a step further from just going in to cash your checks because you could now get an advance on your next check too. Now, the first major chain was called Check into Cash, which was founded by the father of payday loans. Very interesting title. His name was Alan Jones, and it happened after he donated to multiple legislators' campaigns and encouraged them to legalize loans with outrageously high interest rates. Yeah. And then after that, the industry continued to take off. We found a stat that said as recently as the mid-2010s, there were more payday loan stores in the US than there were McDonald's and Starbucks combined. And we know it's not that much different in Canada either. I know since I was at a young age, I could drive past any plaza and basically see a cash for you sign there. So how does the typical payday loan work for the lender? And what does the process look like for these companies to actually give out and then make money back? One of the biggest pieces is obviously the extremely high, astronomical, insane interest rates and other high fees. Now, this is consistent with both the actual payday loan stores, so the one that have that cap of $1,500 per loan, like I mentioned, but also other small cash loan places in general. So if you're in Canada, think Easy Financial, Money Mart, and Cash Money. They typically give out loans of anywhere from $10,000 or a little bit more than that. If we go based on what's actually on the Canada.ca website, they say that there's interest equal to about $17 for every $100 that you borrow. But then these cash loan places present that information to the borrower on a really short-term basis. So let's say they only give the monthly interest rate. So it doesn't sound that crazy. Well, if you went ahead and actually converted that to an annual interest rate, it's something around 442% on average. Yes, 442%. If you compare that 442% to the annual interest rate you might get on a credit card of about 20% on average, that's clearly a huge difference. So just for a second, let's say that a borrower is able to pay back their loan within a 2-week period. They need $400, they take the money, they pay back $468, so the lending company profits $68 in interest, which isn't too bad as it is. But in reality, many borrowers are not going to be able to pay back the money in 2 weeks. And that's when those super high interest rates kick in and really start to benefit the lender. A lot of people who need the money on a short-term basis are thinking that $68 doesn't sound that crazy. I can manage and afford that, except it is that crazy when you have to pay it back in 2 weeks on top of your regular expenses that take up all of your paycheck and you're not going to be able to pay it back. Then when you can't pay it back, the lending company charges you a penalty. How are you ever supposed to be able to pay that penalty if you already can't pay back the loan? What a lot of people do then is they take out another payday loan to pay off the first one, and now they have another one, and this basically just starts this continuous cycle that has no end in sight.
It can get even worse when you use small loans that are larger than your typical payday loans. What they'll do is they'll present the loan as something you can pay off over several years. We watched the special on CBC News Channel's Marketplace series where they pretty much just like take their cameras and try to dive deep into a topic, with this one being high interest rate loans. In one case, they went to a cash loan store where they told the customer that they'd be able to pay off a loan of $6,000 with payments every 2 weeks for 3 years. Now, what the loan officer casually forgot to tell the customer is that over that 3 years, they would have to pay back $5,000 in interest for a total of $11,000 paid back just to borrow that initial $6,000. Crazy. Now, on top of all of that, what's even crazier is that you're basically locked in. A lot of places won't let you pay back the full amount if you have the money before the 3 years are done. So usually what you'll have to do is you'll have to pay your loan back plus the full interest. In the special, they also single out Easy Financial, who they themselves borrow the money at 5% and then they re-lend it out at 40.5% and just pocket the difference. In this particular case, this business was caught lying to their customers, and it was the absolute epitome of just, I guess, success in this business, which is so wrong. There's also this documentary that we were watching on Netflix called Dirty Money Payday, where this one business was actually caught misleading their customers just blatantly and just like super illegally. In this particular example, there was a customer who needed a loan for $300, and in return for that service, the lender said they would charge them a fee of $90 for a total owed back of $390. The customer then gave the lender access to their bank account so they could take out $90 every 2 weeks until the total loan was paid back. Now, after week 5, when the loan should have already been paid off, the customer realized that the lender was still taking money out of their account automatically. The customer then called the lender to figure out what was going on, and were told that they hadn't even started paying off their original balance. Instead, the lender was charging them a $90 fee every 2 weeks for not paying the loan back in full. So now obviously this payday loan was a scam, and the only way you were actually going to clear that $300 was if you paid back $975 in total. Now in this particular case, the lender was caught and shut down, and I believe the founder did end up going to prison. But there's so many of these that are happening around us, and they prey on the most vulnerable people, who are also less likely to call the company and say that something's up when they notice that they're still taking money out of their account.
Now, before we wrap up, I want to talk about what the future of payday loans could look like. There's been tons of regulations in the past that have been put in place, they've been removed, they've been brought back. Overall, the government doesn't seem to know what to do about it. And the main issue that's been brought up several times is that if we either remove or ban payday loans altogether, or set a cap on the maximum interest rate, something that would obviously be a lot lower than 400% plus per year, that obviously the industry won't be as profitable, duh. But the problem with it not being as profitable is that it might close up. Now, at first you might be thinking that sounds like a good thing if the industry just closed up and was gone altogether, but the problem with that is that it really is a last resort for a lot of people who do need money on a short-term basis. Now, in our opinion, and from what we've seen from doing this deep dive on this industry, is that there has to be consumer protections put in place so that as many people aren't getting sucked into this position that they can never get out of. Obviously, this industry is supposed to exist to provide support and relief to people who need money, but if there's a really high probability that these people will never feel support or relief financially, then it just fundamentally shouldn't exist. And in my opinion, in our opinion in general, it just really isn't as simple as saying that the responsibility falls on the consumer to protect themselves, because again, there is a reason that the industry is called predatory. It means that they're focusing in on people that aren't going to be able to make the best decision for themselves. Now, on the other hand, like we've seen historically, if these protections being put in place means that there's going to be less loan stores available, some will shut down because they aren't making as much money, then what else can we do, we do, to make sure and to make up for that smaller supply? Well, a few things obviously need to happen. One is that people need to be making a fair enough wage, that working a full-time job or multiple full-time jobs is enough money that you can actually afford all of your basic expenses. Obviously, financial education goes along with that too. But another big one is that the actual big banks out there need to be more accessible and provide these smaller and short-term loans for people so that they don't have to find these alternative options too.
Payday loans are just one example of how financial systems can be super predatory, especially when you have a vulnerable population. Usually what'll happen is a solution will pop up out of nowhere. It'll say that it's meeting the needs of the people, but really it's just helping one person get really, really rich. It kind of reminds me of when people who have a lot of money donate to charity. Sure, the charity gets some money, but the rich person also gets a tax write-off, and on top of that, they don't necessarily need to give the money up front. So who's really winning at the end of the day? Now, these topics aren't black and white, but it sort of shows the classic story of how the rich just keep getting richer by doing these small acts for the not so rich. Anyways, we hope that you guys enjoyed the breakdown, and we'd love to hear your thoughts and comments down in the comment box below. Have you ever taken out a payday loan? Do you know someone who's ever taken out a payday loan? Let's talk about it in the comments. As usual, if you haven't already shown us some love down below with a like, and you haven't already subscribed right there in the corner, make sure you do so. If you haven't checked out any of our previous videos, make sure you check them out next door. We will be back. You know the vibes. Let's go.